Redfin, the real estate company, just laid off about 13% of their workforce, and they announced that they're going to be shutting down their home flipping business because they are worried about the future of the housing market. And this comes at an interesting time because in September of this year, their chief economist, Redfin's chief economist, came out and he said that essentially that they're worried about the housing market. He said that we're seeing the sharpest downturn in the housing market since 2008. And he said that he is predicting that we're going to see a housing market slowdown and potentially a housing market crash. And so that was what Redfin said in September. Now, here we are in November. Today's November 11th. And now Redfin is laying off 13% of their workforce, and they are shutting down their home flipping business. The reason why they're shutting down their home flipping business is because they're not making any more money there. And the reason why is because interest rates have gone up so much. People don't have the ability to pay 40 to 80% more on their monthly payments because now you have home prices that have shot up along with mortgage rates. And the way that the flipping business works more particularly is you buy a home for $300,000. And then you put in maybe another $100,000 to really renovate it. And now you want to sell it for $500,000 to $600,000, depending on how strong the economy is. And flippers are making a ton of money in 2021 and even into 2022. But now the interest rates have gone up so much. You have buyers that are saying, we don't want to buy a home and pay these crazy high mortgage payments. And regular sellers, not flippers, regular sellers are saying, we don't want to sell our home for a discount. So we're just not going to sell right now. We're not going to move. We're just going to live in this home a little bit longer. Well, flippers are kind of in this tough situation because flippers can't just delay the sale. Flippers have pressure because the way the flipping industry works is most flippers operate on leverage, debt. And the flipping business usually relies on hard money loans, which is essentially high interest debt. So you are on a time crunch to not only flip, but then also sell the home. And so every day that your home doesn't sell, you're paying money on this debt and this high interest debt. And if you have a lot of homes and you have a lot of debt on them, well, now you have all these payments, and that puts a lot of pressure now to either sell quickly or sell at a discount. And a lot of flippers have been seeing their homes sit on the market way longer, which is either forcing them to cut their profits, maybe sell it for no profit, or continue making the payments. And this is why Redfin has decided to shut down their business, because obviously they were doing a lot of flips and it's been much more difficult now than before, where you can start to see the tides changing in the housing market while interest rates continue to rise. So that's the first thing that I want to talk about, which is Redfin, which now brings me to, well, today. Today is November 11th. Today is Veterans Day. I want to first say thank you to all of our vets for serving and supporting our country. Without you, we wouldn't have the freedoms that we do have today. This is one of the reasons why we launched Business Briefs. Today, Business Briefs is my brand new newsletter for business owners, founders, entrepreneurs. It's completely free to help business owners stay up to date on what's happening in the markets. And the reason why that we launched Business Briefs today is because without our vets, without the people that have served our country, we wouldn't have the freedoms to have entrepreneurship and businesses here today. So first off, thank you for your service. And if you are an entrepreneur and you want to understand what's happening in the business economy, what's happening with innovation and trends, you can join Business Briefs for free. I'll put the link to how you can join down in the description below. Now, if you do want to see more daily updates like this, with these kind of raw footage videos, just let me know. I'm trying something new. I want to see if this is something that you'd be more interested in. If you are interested, leave me a comment and let me know yes or no. Just want to see your thoughts on that. A couple of the things that I am concerned about though. One is corporate debt. And number two is the global economy. And then along with that, inflation. So three things, not two. First, on the topic of corporate debt, the big concern isn't what's happening in 2023. It's really what's going to happen with our economy over the next 5 years. Because many times we assume that when we see an economic slowdown, it should happen right now. Why aren't we seeing the effects of this? Nothing's making sense. Well, it takes time to progress. And if you remember, even if you look back at 2008, the 2008 crash didn't happen in 2008. The thing started brewing really in 2005, and they got worse in 2006, and things were slowing down in 2007, and then it imploded in 2008. So you're talking about 3 or 4 years for it to really build up, bubble, and burst. And then the real estate market particularly didn't bottom out until 2012, but then the stock market bottomed out in 2009. And that was because the Fed was able to then pump money into the markets. So that was 2008. Well, here, it's going to take time as well. You have to be patient on that because there's a lot of different things happening. First, I want to talk about the corporate debt side because in 2021, we saw a record amount of corporate debt balloon in 2021, which might not seem like a bad thing. Like, okay, yeah, you were borrowing money really cheap, but at least you were investing into the company, right? Kind of. Where was that money invested? Well, the executives invested this money into stock buybacks. In 2021, we saw a record amount of corporate buybacks happen. I mean, more buybacks than really ever in 2021. And these were leveraged buybacks, meaning corporations were looking at their balance sheet saying, we have a lot of assets on our books and they're valued very high. Everything was valued high in 2021. And they said, this is a great time for us to borrow money against these assets because, like, for example, if you have a home and you saw your home price grow by 30%, why not do a cash out refi, which is what everybody was doing? Well, unlike a cash out refi, where you can get a 30-year fixed rate mortgage, corporations don't get a fixed rate debt payment. They get variable interest rate debt or short-term debt payments, which readjust every year, a couple of years, a few years. And so we saw a record amount of corporations pull out debt to do essentially a cash out refi and then take that cash and not invest it in growth, but rather take that cash, and buy back their own stock. So what does that do? Well, it makes their stock price go up. It makes the executives rich because many of the corporate executives here get paid not just with their salary, but the big payday is from your stock options, your share prices, your stock bonuses. And so you raise the stock price because now you buy back your own shares. The executives got rich, shareholders are happy, and no one's really upset in 2021 because everyone's making money, everything is fine. But now here we are in 2022. And you have all these stock prices that are inflated thanks to the help of corporate buybacks. And then you have now shareholders saying, well, share prices are so high, we have to justify these high share prices now. How do you justify the high share prices? Well, you need higher revenue and you need higher profits. That's not an easy thing to do when you see people struggling spending money because of inflation, people struggling surviving because of inflation. And so that puts corporations in a tough situation where now you have to justify these high share prices. And then on top of that, you have all the debt because now you have to service the debt. You have to pay back your debt. And remember, corporations don't have 30-year fixed rate payments. They readjust. So now what happens? Well, now interest rates are rising, and over the next 12 months, you're going to start to see some of this debt start to readjust with the higher interest rate, which means that now debt costs are going to go up. Your cost of servicing this debt is going to go up. So now corporations are going to be faced with this dilemma. We have all this debt, we have to pay higher payments to service the debt, and we need higher earnings. Well, to get higher earnings, you need cash to invest in the company. You got to invest in your employees. You got to invest in more research and development, more manufacturing plants, more whatever, more products to sell. And now when you're facing this dilemma where you have more and more of your cash going out to service your debt, you have less money to invest, but you need higher earnings, you can start to see where the problems arise. So that's going to be a painful struggle for a lot of corporations that loaded up on the debt that caused their stock prices to soar in the short term with the corporation buybacks. But this is something that is still happening today because you're still seeing companies announce buybacks today with debt while they're doing layoffs. And so this is kind of something you want to think about because you're seeing a lot of corporations. I just saw this happen. This is why I'm talking about it, where corporations are saying we're investing in our company by doing share buybacks. Listen, there's a time and place for corporate buybacks. It's not necessarily a bad thing. You should reward shareholders for investing in your company and trusting in your companies, but there's a time and place for it. And it's not an investment in the company, okay? A corporate buyback is a distribution. You're giving money to the shareholders. You're taking money out of the company and giving it to the shareholders. Again, not a bad thing, but there's a time and place for that. And to justify that as an investment is just dishonest, it's a lie. I mean, it's not an investment in the company. An investment in the company is investing in the employees and the research and development. So that's the next thing you want to be aware of. And this is something you want to be watching over the next, again, this isn't just 2023. This is over the next 5 years, things that will play out along with the housing market. Then you have the global economic slowdown. I made a bunch of videos talking about this. Look at the European energy crisis, the European inflation problem, the Britain economy slowing, the pound getting hit. You have a lot of countries in Europe really getting hit hard. You have the Chinese economy slowing, you have the Canadian economy and the Canadian housing market getting hit. So a lot of issues over there, which, I have other videos on my channel that I've talked about that, so I'm not going to go deep into that. But then you have inflation here. We have people so excited, so excited over 7.7% inflation. 7.7% inflation, better than expected. Okay, let's start with this. The Federal Reserve Bank in 2021 said that we'd be back at 2% inflation by the end of 2022. Here we are, end of 2022. It's not 2% inflation. We're at 7.7% inflation, and you have people celebrating that. Okay, 7.7% inflation is very high. It's not something to celebrate. Yeah, it's better than 9%, but it's much further from 2% than it is 9%. And on top of that, you got to remember, if you're getting a 3 or 4% raise, you're still poorer after that raise because of inflation. If you get a 3% raise and inflation is 7.7%, you're still 3 to 4% poorer after the raise than you were before the raise. So the inflation problem is still around. The Federal Reserve Bank is still going to have to keep raising interest rates to fight inflation. And if you're continuing to raise interest rates to fight inflation, well, that makes corporate debt more expensive. It makes buying a home more expensive. It makes, the number one type of mortgage nowadays isn't a 30-year fixed rate mortgage. It's an adjustable rate mortgage, a 5-1 ARM, because nobody wants to pay 7% for a 30-year mortgage. So they're saying, they're going to the bank, or you could try this for yourself. Go to the bank, say, is there any alternative? I don't want to pay 7-point-some% for my mortgage. They'll say, oh yeah, look at this adjustable rate mortgage. You can get it at 5% for the first 5 years, and then after 5 years, mortgage rates will probably come down. Why are they saying that? Well, the Mortgage Bankers Association, MBA, it just makes no sense. The Mortgage Bankers Association came out and they put out a prediction that mortgage rates are going to fall to 5.4% or so, something like 5.4 and some change in 2023. What is their justification? Nobody's buying homes. Nobody's borrowing money. And so because of that, the Fed will have to cut interest rates. So it's just kind of this funny little cycle challenge that you're seeing where people are saying that the Fed's going to cut rates, not because of anything justifiable, but just because people aren't buying homes, not because interest rates are, whatever. You get the idea. So this is where you can start to see all the different factors that you want to be paying attention to in the economy. This doesn't mean you got to be worried and not do anything, but just be aware of what's happening. That way you can be smarter with your money. Now, of course, I have business briefs for entrepreneurs. I also have market briefs for investors to help you keep you up to date on what's happening in the financial markets. I also have that link for you down in the description below. But this is where you want to be aware of what's happening. That way you can make smarter decisions with your money. Now, the last thing that I want to say is, of course, on the topic of crypto, I talked about FTX, which, a lot of craziness going on. I used to be sponsored by FTX US. I haven't worked with them in a while. I don't work with them anymore. FTX US is separate from FTX.com. FTX.com is declaring bankruptcy. FTX US, you can still pull your money out of FTX US. Don't risk it. They're probably going to have to shut down at some point too if FTX.com continues to have these issues. So be smart here, pull your money out. And if you listen to my videos, please just understand, you should never keep your money in an exchange, ever. Your crypto, your exchanges are supposed to be exchanges. They're not a wallet. It's not a place to keep your money. I think I've said this, dozens of times now. Never keep your money, your crypto, in an exchange. Get in a wallet, get it out. So if you're using FTX US, it's still open. You can still make trades. You can still pull your money out. If you haven't done that, please do so. They announced that they might have to halt trades, not now, but in a few days. Don't listen to them. Get your crypto out. Just be safe. Why not? And I am sorry. I made a video talking about this, that FTX US was supposed to be a good company. They had a lot of support. Everything looked good. Well, sorry, it's a crappy situation, but you can get your money out. Nobody should lose money on this. You have a lot of warnings, and you should never, ever, even if it's Coinbase, it doesn't matter what you're using. It doesn't matter what exchange it is. Never keep your crypto in an exchange, okay? It's not supposed to be used as a wallet. Put your crypto in a wallet, not an exchange.